Tax planning is by far one of the most impactful things that you can do as a business owner. So often I see business owners focusing on increasing revenues, decreasing expenses, all so they can keep more money, but they don't spend time thinking about tax planning. Tax planning is a tool that allows you to keep more money in your pocket. So today I'm going to take you through a masterclass of some of the most impactful tax planning moves that you need to consider. And I'm going to go through our tax planning software to help walk through them with you. As a business owner, you have the most tax planning moves, so much more than any other employee out there, but they don't just come to you. You have to search them out. You have to plan around them. Let's go through some examples. So the first one is looking at being an LLC versus an S Corp. So on the left, you're going to see this situation where they're just an LLC. They have zero in wages and they have about $800,000 in profit. A couple things to note here. They have self-employment taxes on all $800,000. It's 15.3% to 168.8, and then above that it's 2.9, and then there's an additional 0.9% Medicare tax that kicks in. And on top of it, one thing that you'll see is that the qualified business income deduction is zero. Hold on to this. We're going to talk about it later. So this person would have a total taxable income of about $680,000, and they would owe $243,000 in tax. If instead they were an S Corp, with one caveat that they're an S Corp and they are not an SSTB, which basically means they're not a service business. So if you have a product-based business or something along those lines, you'll get the qualified business income deduction. So, but in this scenario too, what's happening is this person is going to pay themselves $277,000. And if you look in here, it's really $300,000, but we're having them max out their 401k. So $277,000 of wages. And then that will reduce their profit. And now their profit gets down to about $432,000. So what's the impact of this? Their taxable income goes down quite a bit, and they end up owing, let's see, just under $100,000 less in taxes. And what really did they do in this situation? They reduced this by adding salaries, and they got a lot in the qualified business income deduction, which we're going to talk a little bit more about there. The first tax planning move is understanding entity selection. So you have a tax selection. A lot of people say I'm an LLC, but they don't realize you can be an LLC tax as a partnership, as a sole prop, as an S Corp. And the right entity structure can be the difference of paying a lot less in taxes. Scenario 2 is really just talking about adding the right business retirement account. So business retirement accounts, you can have a 401k, a solo 401k, a SEP IRA. In this example, we're looking at a solo business owner who can have a solo 401k. The one big thing here is we'll look at the left side, $300,000 in wages, all things the same, but they put $0 in a retirement account. If that ends up happening, they end up with $830,000 of taxable income, $234,000 in tax. If instead they decide to set up a solo 401k, and based on their wages, they can do $23,000 on the employee side, and then they can do 25% of W-2 wages on the employer side, meaning they can get $69,000 in. So you'll see wages were reduced by the $23,000, and then you'll see profits were reduced by the 25% of W-2 wages you can add in. And a couple things to note. One, you'll see QBI deduction is lower. Why? Because they reduced profits. Because they reduced profits, they got less in the qualified business income deduction, but all $69,000 still was pre-tax. So it reduces Fed and state taxes. So just on a federal level, by doing this, they'll have about $22,000 of tax savings at this threshold. Super impactful. Number 3 is PTET. For those of you that don't know, you are only allowed to deduct federally $10,000 of state and local taxes. I got clients in California, they make millions of dollars a year. They're paying hundreds of thousands in state taxes, but federally they can only deduct $10,000. But that's without PTET. PTET is basically the pass-through entity tax. So any pass-through entity, you are able to have PTET. And what PTET does is it allows you to pay your state taxes federally through the business. So that same example, right, if you have $100,000, you're able to do that and get all of that in ad deduction. So let's look at this example. Basically the same on both sides. The difference is that on this right side, you're going to see, oh, they paid those state taxes through the business, which is why it came through as a deduction here. So if you look at it, income is reduced because of that, taxable income is reduced because of that, and tax taxes paid were reduced because of that. So in this example, they ended up paying $24,000 less in taxes because they elected into PTET. You really didn't do anything different. You elected into it, you paid the state taxes through the business. You have to work with your CPA to look at state specific, when does it pay, is it 1 time a year, 2 times a year, etc., to make sure you do it correctly. Once you elect into it, you have to do it. But at the end of the day, you're getting to deduct a lot of excess taxes above that SALT limit, that $10,000, by electing into PTET. Most states now have this, but not all states do. The last one is just about charitable giving. You get a dollar for dollar reduction of your taxable income. So if you make $1 million, you give $50,000 of charity, you now only have $950,000 of taxable income. So it saves you by fed and state taxes times by that deduction amount. But the other thing that you need to know is you only benefit from this if you don't take the standard deduction. If all of your state and local taxes, charity, etc., amounts to $25,000, well, that's not going to help you because the standard deduction is $29,200. So it only benefits you in the amount above the standard deduction. Let's look right here. Same example, $300,000, $700,000 here. The only real difference is standard deduction, $29,200. This one, there's some charitable giving that gets done. So if you see all three things are the same, mortgage, interest, the difference is you give $4,000 to charity. So that gets you above the standard deduction. Even though you gave $8,000 to charity, you only benefited by $3,800 because it was over the standard deduction. In the first example, somebody still gave to charity, but they didn't get above the standard deduction, so there's no benefit. So a couple strategies you want to think about with charity is, one is bunching. So hey, if you don't really get above their standard deduction, you could choose to say, hey, every 2 years I'm going to give to charity. So if I was going to give $10,000 each year, I could lump all $20,000 into one calendar year, so more gets used up. And then the other one to think about is a donor advised fund. With a donor advised fund, you get 2 benefits. So let's say you have $10,000 of Apple stock you bought a long time ago. It's worth $100,000 and you're like, I want to donate $100,000 over the next 5 years. What you could do is you could donate this $100,000 of Apple stock to a donor advised fund. The first benefit is you avoid the $90,000 of capital gains. So if you have 20% capital gains, 3.8% net investment tax, 5% state, you might save $25,000 there, but then you also get a deduction against your income of that $100,000. So 37% tax bracket, that could help save you $37,000. So you get that double benefit versus when you donate cash, you only get the deduction against your income. Both of those are really good tax planning tools as it relates to charity. So just to kind of recap, some of the best tax planning moves that you need to be considering as a business owner is, first, entity election. Should you be an S Corp? Should you be just an LLC, taxed as a sole prop or a partnership? Or should you potentially be a C Corp? Are you going to get QSBS and be able to exclude 10 times your basis or $10 million in a capital gain down the line? Then you want to think about retirement accounts. How do you optimize retirement accounts, and what is the right retirement account? Is it a solo 401k, a SEP IRA? Is it a regular 401k? The next one is PTET, being able to pay those state taxes federally through the business so that way you can get a deduction above the $10,000 max. And then the last one is really giving to charity. So those are 4 of the most impactful tax planning moves for you to consider. The rest above and beyond that are really, using Roth IRAs and getting tax-free growth, or setting up Roth conversions. Hey, I just sold my business. I have a lower taxable income. I can convert pre-tax assets to post-tax assets. You can consider cash balance plans to stack on top of your solo 401k to defer more. But at the end of the day, tax planning is extremely valuable. It is a way to ensure you keep more money in your pockets. So do the tax planning and hire the right team to help you make sure you are doing the best tax planning available. Thank you for watching. If you enjoyed this video, please leave a like and go follow my page for more personal finance content. And as always, if you have any thoughts, please leave it in the comments below, and I promise to get back to each individual comment. See you next week.